Thank you to everybody who has joined us so far for this webinar on planning and borrowing options for medical practices in the COVID-19 world. My name is Carissa Miller. I'm the Program and Communications Specialist for Montgomery County Medical Society. Just a few housekeeping items before we do begin. We have muted all of our participants upon joining the meeting. So if you're on the phone and you'd like to unmute yourself, press *6. For everyone else, you should see a black bar at the bottom of your screen, and you can press the microphone icon to mute and unmute yourself. So we do welcome your questions. We're going to have a Q&A portion at the end of this session. What we'll do is we'll give priority to the pre-submitted questions first, followed by questions in the chat box, and then finally audio questions. Today's program will provide a brief summary of the CARES Act, including the Paycheck Protection Program and economic injury disaster loans, as well as both technical and practical information about the loan forgiveness components and tax considerations relating to the CARES Act. We will also address the Family First Coronavirus Response Act and some healthcare provider-specific financial assistance coming from HHS, with a look at how that assistance works within your practice. This is our second webinar on employment law related to COVID-19, and we're very fortunate to be joined again today by David Shapiro and also his colleague Scott Mirsky of the law firm Paley Rothman, which is based in Bethesda. And today we also have Aaron Boker, CPA, on the line from Aronson LLC, who will help us to shape the discussion about tax implications and relief aid compliance. So thank you to David, Scott, and Aaron for being here today. And I'll go ahead and turn the session over to you.
Great. I will see if I can figure out how to get our slide deck running here. All right. Hopefully that did it. So thanks everybody for joining us. We have a lot of content, but I wanted to say that there's been a lot of change, some of it very good, some of it a little disheartening in terms of how quickly the government's money and support is going out, but there are still a lot of related issues that come into play. In particular, I still think that the lion's share of questions that we're getting either relate to borrowing money, what happens once you borrow the money, or what am I supposed to do with my employees? So our hope is that between the three of us, with Aaron, Scott, and myself, we should be able to answer your questions at the end. We want to treat this as a little bit of a summary and an update as to where things stand. Many thanks to the Medical Society for asking us to participate again. We've had a long and enjoyable relationship. I'm glad that we can come together to provide these programs. Okay, so let's just jump into it. So the CARES Act, as many people know, was signed into law on March 27th. And since then, it was certainly the largest and still growing spending program in US history. It was initially $2.2 trillion. And this was actually phase 3 of what the government is trying to do to help support businesses with respect to COVID-19. The first was an initial appropriations act. The second was what many of you are already familiar with, was the initial $104 billion that went into the Family First Coronavirus Response Act. The third was the CARES Act. And then what we'll see in a little bit is there's actually been an update because the money that was provided for what most of us look at as the important nuts and bolt part of the CARES Act ran out pretty quickly. The primary objectives of the CARES Act were really to keep, at least for what we're going to be talking about, was to keep workers paid and employed. Obviously, this wasn't just out of benevolence, but there's a feeling that one way or the other, the government was going to be stepping up to help fund keeping workers going. Either they were going to do it by coming up with a large program like this, or they were going to do it through the unemployment program. And I think it was pretty clear early on that unemployment alone wouldn't be able to support the demand if the government didn't step in. In addition, there was the expansion of paid leave and sick leave, but there are also some steps taken to provide tax relief to individuals and businesses. And if you look at where the dollars have been allocated over time, there is also a huge amount of money that went into the program for bolstering the healthcare system in America and for providing testing. So obviously one of the key pieces and one of the things that most people are asking questions about these days is the Paycheck Protection Program, what most people refer to as the PPP. So Aaron, if you can give us some background on that.
Great, thank you, David. And what I'd like to do is just give kind of a brief overview of where we got to where we are today. And I know the focus right now is loan forgiveness, but let's do a recap. $349 billion was initially put into the PPP program back in late March. And the way this works is the loans are done through an SBA 7A loan program, which is done directly through the banks. And most banks, your national, your regional, and a lot of the community banks should be SBA loan approved. So they'd be the ones doing the loans directly. The maximum loan is the lesser of $10 million, or what's most likely going to happen for a lot of people is 2.5 times your average monthly payroll cost. And we'll get into what payroll cost is in a second. The loan program is open until June 30th. And what happened was this program came to life in late March, and it was open for business in April 3rd. And then within 13 days, they ran out of funding. And they just did a second round of funding last week, and they reopened the SBA program just yesterday. And we don't know what the timeline is going to be for when that's going to run out, but it is back up and running. But as you can see, we're already on round 2 of funding. Next slide, please. And the way it works, who qualifies for the PPP loan? It's any business that was in operation as of February 15, 2020 and has 500 or fewer employees. And there are a couple caveats to this 500 employee rules, that there was a special carve out for hotel and restaurant franchises. So there's a lot of corporate owned hotel and restaurants. And if you aggregate all their hotels and restaurants, they're going to be over the 500. So what the National Restaurant Association did was they said, hey, look at it on a restaurant by restaurant or unit by unit basis. And so as long as each restaurant or each individual hotel has 500 and less employees, they're eligible for this. There's also affiliation rules. So, you know, we see a lot in our practice where there's a lot of common ownership. So same owners, multiple companies. So what they say for this purpose is you got to roll up all the companies and add up all the employees. If it's under 500 employees, full steam ahead. If it's over 500, all the employees are disqualified from this, or companies rather. Other people that are eligible for the PPP loan program are sole proprietors, independent contractors, and any other eligible self-employed individuals. And the way that the payroll cost is calculated is that it's defined as your average monthly payroll cost. So you take the sum of all your wages, all your benefits, such as health insurance, dental insurance, and you also look at state unemployment taxes and any matched pensions like a profit sharing plan or 401k. And then what you got to do is you got to carve out any excess salaries for anybody that's making over 100,000. So they're very specific. There's a $100,000 cap per person for this exercise. And then when you multiply by 2.5, that's going to be your payroll cost for purposes of applying for the PPP loan. Okay. With that, I'm going to turn it over to Scott to tell us about the payroll cost more specifically.
Yes, so just to address some of the specifics regarding payroll costs, again, as Aaron said, you get up to 2.5 times the amount of your payroll costs, and it's salaries, wages, commissions, and similar compensation, profit distributions, all sorts of vacation, parental, family, and medical leave. It's also, if you have a separation agreement that you're paying off, it would be included group healthcare benefits, retirement benefits, unemployment tax, and unemployment compensation. One of the confusions or areas that we did not have clear guidance on originally, but we do now, is that you do not include any payments to independent contractors. And that's because obviously they can apply on their own for the benefit. So when you're calculating your 2.5 times and your payroll costs, you cannot include any payments to independent contractors. David, next slide. The good news is that a lot of your PPP loan can be used to cover many things, including rent, business mortgage interest payments on debt occurred before February 15th. And if you did take out an SBA economic injury disaster loan, that can be refinanced and enrolled into your PPP loan as well.
So in addition, the payroll costs don't include compensation to individual employees earning over 100,000 per year. Aaron will give us some additional information about how that works. It also doesn't include payroll taxes and income tax withholdings from February 15th through June 30th. Obviously, it's not going to be used for compensation employees whose principal place of residence is outside of the U.S. And then obviously the idea is to make sure that benefits are getting paid to people, but it's not intended to be a double dip. So if you have employees who are receiving wages paid under the Families First Coronavirus Response Act, it won't cover those either.
And there's some other important consideration when it comes to the PPP loan. First and foremost is that as a business, if you're going to apply for this thing, you need to demonstrate that there's some type of current economic uncertainty that makes this loan necessary to support your ongoing business. So when this first thing came out, you may have thought in present day, I'm okay. But then if you ask the question where you're going to be in 2 months, and if there's any uncertainty, you're good to apply for this thing. So we imagine that most businesses would meet this criteria. Also, another consideration, you got to make a good faith certificate that any loan funds you're going to use it to retain and maintain payroll. And anything that's not used for payroll will go for mortgage interest, lease payments, and utility payments. And also, there's a 25% cap on what you can use for non-payroll costs. So at least 75's got to go to payroll. Other considerations, what's nice about this is the loan payments, you can defer up to 6 months. There's no collateral personal guarantee like most traditional loans. Now, on this last bullet point, interest rate of 1% is fantastic. It's a very low interest rate. But one thing you got to be careful about is there's a loan maturity of 2 years. So we'll get into loan forgiveness in a sec, but assuming you don't get 100% loan forgiveness, you have 2 years to repay what's left of the loan. So that's a very important key aspect.
Great. So I get to talk about the loan forgiveness portion, which is probably the portion that most people are excited to hear about. And the PPP, the main component is that employers are eligible for loan forgiveness equal to the amount that the borrower spends on certain things during the 8-week period starting on the date that they originate the loan. So once you take the funds, you're looking at the 8-week period going forward from that date. And if at that point, your payroll costs going forward from the date of origination and 8 weeks thereafter, 75%, if you use 75% of the money can go towards the payroll. And it's the same definition as payroll costs that we discussed earlier. So it does include fringe benefits as well. You can also use for 25% of the funds for the forgiveness part can be used for mortgage obligations incurred for mortgages that were entered into prior to February 15th, rent, as long as the leasing agreement originated prior to February 15th, as well as payments on utilities, gas, water, transportation, telephone, and internet. And again, those agreements would have to be entered into prior to February 15th. Like I had said earlier, you can also refinance any SBA EIDL loan that was made between January 31st and April 3rd. It's important to note that the loan forgiveness cannot exceed the principal amount of your PPP loan, and the amount of your PPP loan forgiven will not be considered income to the business.
So great summary on how the loan forgiveness works, but now we're going to talk about how can the loan forgiveness be reduced? And we're going to go into the calculations in a sec, but what it boils down to is that if your average number of full-time equivalents, which we'll define that in a minute, if that decreases over the duration of when you have the loan, that could work against you. And another variable that could work against you too is that if you have any employees on payroll that make less than 100,000, and if you slash their payroll by 25% or more during the covered period, which is 8 weeks from the date of the loan, that also works against you as well. And we're going to go through a couple examples of calculations. Next, please. The way we tackle this, we look at this as a two-test approach with regards to whether or not you qualify for loan forgiveness or not. And the first test is, what if the business brings back all the employees and you restore wages? And to put it this way, if you pass test one, you're golden and you're good for 100% loan forgiveness. So what this boils down to is that if you spend at least 75% on payroll and 100% of the loan proceeds goes out the door, all within 8 weeks of when the loan is originated, as and when you get the cash. And if you restore your full-time equivalents, and what a full-time equivalent is it follows the Affordable Care Act, where it's defined as the number of people that work 30 more hours per week. So the way this would work is, let's use the three of us as an example. I work a traditional 40-hour work week. I'm one full-time equivalent. If David, works 15 hours a week, he's considered 0.5, 15 divided by 30. And if someone like Scott were to work 20 hours a week, he would be 0.67, 20 divided by 30. And this goes on. And you would do this for your full-time folks and your part-time employees. And that's how you get down to that full-time equivalent number. And what they're saying for this calculation is that, you got to use February 15th to 2020 as your baseline for what your full-time equivalent, threshold is. And if you bring that back, by June 30th, meaning if you had 100 full-time equivalents on February 15th, and if you get to at least 100 by June 30th, and you're good. And that's also assuming you don't slash anybody's payroll. So 100% of the loan gets used, you restore the full-time equivalents, don't slash anybody's payroll by 25% or more, you're good. You get full loan forgiveness. Next slide. But let's say what's going to happen for many folks is, let's just say, what if you can't meet that criteria? What if you can't restore your full-time equivalents? And what if you can't, maintain the wage basis? So then what happens is there's a calculation that you got to do. And the rule of thumb is you got to look at, okay, let's look at the greater of the salary reduction or the greater of the percentage of the employees that I reduced. And the higher of the two is how much your loan forgiveness could potentially be reduced. Slide. So we're going to look at the full-time equivalents first. So what they're saying is, okay, let's say you don't restore the full-time equivalents by June 30th. So what they're going to look at is, let's compare your full-time equivalents during the 8-week period since the loan origination versus either option one, February 15th to June 30th of last year, or January 1st through February 29th of this year. So to go through a quick example, let's use option one. Let's say between February 15th and June 30th, I had 100 full-time equivalents. But let's say my average full-time equivalents during the 8-week period was 80. 80 over 100 is 80%. So what that would mean is the bank could say, all right, we're going to cut your loan forgiveness by 20% because you only had your full-time equivalents working at 80% capacity of option one, or this time last year. Next slide. The other calculations, they say, let's take your total payroll cost and let's look at how much you cut your employees' compensation. So what they're going to say is, take all your employees that were making under 100,000, and for anybody that you slash 25% or more, we're going to take those payroll costs out of the equation, out of the potential loan forgiveness. And the baseline for this is they're going to look at the full quarter prior to the loan origination date. So if the loan was, for a lot of people, it originated, let's say April, some may carry over to May. When they say the most recent full quarter, that's going to be January through March of 2020. So they're going to compare, the wage base January, March of 2020 for an individual employee versus the 8-week period that's covered by the loan. And again, if it slashes by 25% or more, that payroll reductions is going to come out of the loan forgiveness. And, with the loan forgiveness, I can tell you there's going to be, we're waiting on guidance on this, but there is going to be a lot of regulation. There's going to be a lot of, review that's going to be done by the bank. So what's really going to be critical is having good record keeping when it comes to this. And here's a few recommendations for best practices. The first is keep the PPP loan separated from your other, cash accounts, such as, you may want to use a separate bank account so you can track that, on its own. And then you got to track the PPP loan proceeds very carefully. You can do it through a journal or account ledger. And this will be a lot cleaner and a lot transparent when it becomes loan forgiveness time. The bank says, show me your records of what you did with the PPP loan proceeds. You'll have a nice little summary to give them. And then you're going to need to have good records such as payroll, You're going to need to keep receipts. So for things like rent, utilities, mortgage interest, they're going to want invoices, basically documentation to support anything that went out the door for the PPP money. And then as documentation, you know, the first and foremost thing they're going to want is they're going to want some type of record that shows what was your full-time equivalent account on February 15th this year versus June 30th. And a lot of these payroll companies should be able to give you that report that calculates the full-time equivalents for you, but the bank is going to need something to be, you know, comfortable so they can, you know, measure the baseline to present day. And then you need proof of where the PPP money went during the 8-week period. So payroll records, proof of payment for the rent, utilities, and mortgage payments. And then the big thing is, as a borrower, you must attest that you verified and accurately verified that all the payments were for forgivable costs. You didn't use it for anything that you didn't say you would use it for. And then on the tax side, here's what we know and what we don't know. What is a given is that if any loan forgiveness comes through, it's going to be non-taxable at the federal level. So generally, anytime there's any type of loan forgiveness or cancellation of debt, it's usually taxable income, but there's going to be an exception for this type of loan forgiveness. But however, what we don't know and our concern is that this could make this a little less attractive from a tax standpoint is we don't know if the expenses that are tied to that loan forgiveness are going to be deductible. So you could have $100,000 of, you know, debt forgiveness as income, and then $75,000 of payroll, $25,000 of other expenses. But it could be quite possible where the $100,000 of income is not taxable, but the expenses tied to it are not deductible. So you're back to where you are effectively. And then on the loan forgiveness side, you know, our concern is that, and we're not going to know this until probably later this year, but we're not sure if the states are going to play ball. You know, it might be non-taxable to federal, but the states may say, tough, it's taxable in my jurisdiction. And it wouldn't surprise us because a lot of these states are hurting for money right now. So it's likely they may say it's income. Next slide.
So, you know, what's interesting about all of this is it's very technical, but, you know, if you were waiting for, or if you had applied for, or even worse, had not yet applied for funds through phase 3, which was the initial tranche of the 2.2 trillion that was allocated to the PPP, well, it's gone. So it didn't take long, as Aaron noted above, for that to leave. So as of the end of last week, there was an interim funding bill that was passed, which, you know, is sort of colloquially referred to as phase 3.5. This was signed just towards the end of last week, and it provides, in total, an additional $484 billion more. I think that for many people who don't understand our national economy and our national debt, the coronavirus has certainly provided a quick primer in terms of how dollars really look on a global level. You know, it wasn't long ago that we were talking about things in hundreds of thousands, maybe hundreds of millions of dollars. But, you know, now that we're in this world, we're talking about billions of dollars. So the beauty of phase 3.5 is that put an additional $320 billion into the PPP. This is something that you need to act quickly on. We'll talk about that in a minute. The other nice thing about this is they did earmark of that $320 billion, $60 billion for loans by small banks. This is small banks. This is some credit unions that participate. But the nice thing is that it's allowing for some groups other than the very, very large mega banks, which seem to have dominated the initial loan funding, to actually participate and help as well. In addition, there was an additional $10 billion added to the Emergency Economic Injury Disaster Loan. These are those EIDLs that we'll talk about. An additional $50 billion added to the SBA Disaster Relief Fund. The majority of the rest of the money is earmarked mostly for administrative costs and for hospitals. So if you haven't submitted a loan yet, this is something that you should act on very quickly, because as soon as the dollars became approved at the end of last week, the SBA announced that they were going to start accepting PPP applications again yesterday at 10:30 a.m. So if you didn't submit an application earlier, or if your original application wasn't granted, you should call your bank immediately. You should also call your accountant, because there is a lot of work that goes in to the application. Not that the application's complicated, it's actually very, very simple, but there's a lot of data that you need to have available so you can get this submitted. You should remember that applicants need to certify that the current economic uncertainty makes the loan necessary. I think that we're going to start to hear about a lot more enforcement actions in this regard, because a large number of dollars that went out in the first round of PPP loans went to very large companies, and there's some concern that it went to companies that probably didn't need the dollars, at least not immediately, as much as some smaller companies did. So these relate to the certifications that Aaron was talking about in terms of the application process. Of course, there's a nuts and bolts component for most of us who have businesses in the area and that have employees. Certainly, the three of us are in businesses, and we all have employees, and we understand what you're going through. And I would say that probably 2 out of the 3 questions that we're getting still relate to employees, and a piece of that is the Families First Coronavirus Response Act, what's referred to as the FFCRA. So, Scott, can you give us a little bit of background and update on that?
Sure. So just some of this should be a refresher if you listened into the first webinar, but we do think it's important to reiterate the key components of the FFCRA. And essentially, it's effective now through December 31st. The Department of Labor was staying enforcement of the act for some time, but now has said that they will start enforcing violations. And essentially, it gives additional leave benefits, paid leave benefits, to employees. And there's 2 components. One is the Emergency Family and Medical Leave Expansion Act, and the second component is the new federal paid sick leave law. So the first one, the Emergency Family and Medical Leave Expansion Act, only provides extra leave time for individuals who need to take leave because of lack of school or childcare for their children. And it covers employers with 500 or fewer employees, and the employee must be employed for 30 days to be eligible. And essentially, it requires the employer to pay for what amounts to 12 weeks of leave. The first 10 days can be unpaid, but that's covered by another leave benefit that we're going to discuss in a minute. So essentially, it's really 12 weeks of paid leave. However, it is important to remember that you only have to pay the employee 2/3 of the employee's regular pay rate, up to $200 a day per employee, which is a $10,000 aggregate. So there is a cap on that. There is a way to provide for an exemption with the Department of Labor if you can argue or assert that complying with the statute will jeopardize the viability of your business as a growing concern. It does require you to reinstate the employee unless you have less than 25 employees. And again, there's certain requirements that you must meet if you have less than 25 employees, and you can't reinstate. But that is an important part of the act, that you do need to restore them to the same or equivalent position when they return to work. The other benefit that was recently passed under this act is the new federal paid and sick leave law, which is referred to as the PSLL. Again, this also covers employers with 500 or fewer employees. In this statute, the employee is covered from the first day of hire, and you must provide employees with 80 hours of paid sick leave for various reasons that I've listed in numbers 1 through 6. It is pro rata if you have part-time employees, but essentially it covers employees who have to quarantine or isolate due to COVID-19, if they have COVID-19 symptoms, if they need to take care of an individual who has COVID-19 symptoms, and it also covers the lack of childcare. And again, this is where you would have to pay 80 hours up front to the employee who needs this leave. Again, there are caps associated with this, and that's on the next slide. But essentially, if the leave is needed for yourself or an issue that you're having, the caps are much higher. And if the caps per if you're doing the leave for childcare or to take care of someone in your family, then the leave caps are significantly less, between 511 per day and 200 per day. And again, employers can apply for an exemption if it will jeopardize the viability of their business, but that exemption will only apply if the person's eligibility is tied to the lack of childcare or schooling. It is important to note that, and we noted this originally, that healthcare workers can be excluded from the provisions of both of these new leave provisions. And we are anxiously awaiting the Secretary of Labor's definition of what a healthcare provider is. And as you can see, it's very broad. It includes anyone employed at a doctor's office, hospital, healthcare center, clinic, and it goes on and on and on and on. So it is very broad, and it does allow healthcare workers to be excluded. However, I would point out that the Department of Labor guidance also says that employers of healthcare workers are encouraged to be judicious when using this definition, and should use their best efforts to provide the person with the necessary leave. The guidance goes on to suggest that maybe a healthcare worker would not, or their employer would not provide them leave under this act to care for a family member who has COVID-19, but should consider providing this benefit if the individual themselves has the need to take the leave due to COVID-19. And it is also important that other statutes might be involved. Maryland has a sick and safe leave statute. Montgomery County has a sick and safe leave statute. So there are a lot of considerations. So if you have any employees who fit into these categories and you're curious or need some guidance regarding if they are exempt or not, or if you have to comply, we do encourage you to reach out to legal counsel before making a decision. The one upshot of the FFCRA is you do get tax credits for any amounts that you pay under the act. So if you pay out employees for their qualified family leave, you do get a dollar for dollar credit. And so that is one nice thing. Again, you'll need to provide, as Aaron was saying, documentation is going to be very, very important. You're going to need to have documentation showing why the person took the leave and proof that they needed to take the leave. And this will be allowed, you can claim this quarterly, and it allows you to lower your payroll tax liability for your quarterly tax payments. And again, this is more information regarding how you calculate your tax credit and the withholding and which taxes are eligible. It's the federal income tax, the employee share of Social Security and Medicare taxes, and the employer share of Social Security as well with taxes. And essentially, it allows you to pay less of your taxes as they come due. But again, you'll need to have the appropriate documentation to support that. And we do, so we've kind of had a formula here on how to calculate your tax liability. You can go through that. You look at your payroll tax liability. You look at how much is fits into the qualified sick leave wages. And then you can figure out what your maximum credit is. And it is 100% credit. But again, remember that the statutes have caps. So if you do pay an employee more than is required, for example, if you're only required to pay them 2/3 of their wages and you pay them 100%, you will only be able to get your tax credit up to 2/3. So you have to be careful and you have to track that. And yeah, and so and there is a provision or a possibility that you could be entitled to a refund if you overpay.
All right. Well, I think Scott has helped us all understand exactly why this is where we're getting so many questions, because there are a lot of moving parts and the information that we're getting is coming out very piecemeal. So Scott, I don't know if you know what the exact number is on the DOL's Q&A, but it started out with about 9, then it jumped to about 23, and now it's up to about 68. And
Yeah, I think it's in the 70 or 80s in guidance now.
right. So now, to their credit, the DOL has been doing a very good job trying to provide guidance on these issues, and it's also nice that they've managed to keep all of the Q&A flowing through, so you can see how the questions have built over time. But clearly, this is a big issue, and we anticipate that there are going to be a lot of similar questions and issues that are coming up once the loan coverage period is over and you're now sitting down with your accountant to talk about how do we do all of these calculations to figure out what's forgiven. One of the questions that's been asked to us regularly, and one of the things that we were asked to touch on here, is some of the other loan options and possible help that may be available. And it's sort of a mixed bag because there is a significant amount of activity on a local, federal, and state level. But I think, as you'll see as we go through a lot of these things, a lot of them are either temporary patches or they're situations where there were dollars available, but they've been gobbled up very, very quickly. And I think that's what we saw with the PPP loan. I think everybody knew that those dollars would be requested quickly. I'm not sure that it was anticipated that they'd be gone within 13 days. Reviewing those, there is something called an employee retention credit. It's only available to businesses that aren't getting a forgivable PPP loan. So these are businesses that have had to fully or significantly suspend operations due to COVID-19, or they've experienced a greater than 50% reduction in gross receipts. For many of the people on the call today, we anticipate that they may be looking at their receivables now to say, gee, we've really had a significant impact. Maybe this is something that's available to us. If so, it's a refundable tax credit against the employer's payroll tax. It's 50% of the first $10,000 of wages paid between March 13th and December 31st. But there is a maximum credit of $5,000 per employee. Obviously, if you have a number of employees, that's nothing to sneeze at, because I think that most of the people that we're dealing with now feel that every little bit helps. If the business has more than 100 employees, this only applies with respect to wages or health coverage expenses for employees who aren't working due to COVID-19. If the company or the business has fewer than 100 employees, it will look at all wages and expenses, regardless of whether or not the employee is working. Wages that are paid for employees on FFCRA covered leave, these are the two different leave programs that Scott had talked about. Those are excluded from the calculation, and there's a good reason for that. The same idea is the government wants to help, but it's not looking to give people a double dip. So the EIDL loans, this is one of those mixed bag things. These are economic injury disaster loans. These are one of the loan programs administered by the SBA. And I'll take a minute to note, if you haven't been to the SBA's website, or if you haven't been to the state's website, both of them have very, very good, easy to follow guidance on what kinds of loan vehicles and grant vehicles are available. Right now, the information is a little disappointing because so many of the dollars have been gobbled up, but it is worthwhile to keep checking back. Both the SBA and the state have done a very, very nice job at updating that information regularly. The EIDL loans are intended to help businesses that are suffering from an economic disaster. These days, that's everybody. So COVID-19 is deemed to be a national disaster. So you don't have to worry about that aspect of the loan. They're available for businesses with fewer than 500 employees. And again, this includes sole proprietorships, independent contractors, and self-employed persons. There's a $2 million cap on the amount of the EIDL loan itself. But what's very appealing is that if you file, there is a $10,000 emergency advance that comes out, I don't want to say automatically, but almost automatically, and that $10,000 is a grant. It is not something that has to be repaid. To receive the emergency advance, you must qualify as a small business. So that really goes back to SBA rules and the SBA statute, and it's going to look at your business based on the number of employees you have and your revenue. As I noted, the advance part doesn't have to be repaid. Where there is repayment, it's deferred for 6 months. And one of the other nice overlaps that they provided is that the amount that you receive, if you receive an EIDL loan, can be used, the proceeds from the PPP loan can be used to help pay for that, but the forgiveness is subject to the PPP requirements. So you can't necessarily use these dollars to pay it off and assume that you're going to get then loan forgiveness on the PPP side. Unfortunately, as with the PPP loans, there was a lapse in appropriations, so new applications aren't being accepted right now. However, since there were additional dollars funded into this through phase 3.5, the SBA is now revisiting applications that were in the queue. So if you had an EIDL application in process and the money ran out, the SBA is now beginning to revisit those and process them. Obviously, if there looks like there are going to be dollars available towards the end of that process, the SBA is going to let people know. Again, a good reason to be checking their website. This information in terms of when they're processing applications and when they're going to accept applications, they've been very good about trying to post that in advance. Montgomery County did a wonderful job advertising their public health emergency grant. It's a PHEG program. This, unfortunately, much like some of the other programs we've seen, the application window on this just closed towards the end of last week. There was $10 million available in $75,000 grants. And I think that the county, having seen how quickly dollars were being claimed on these federal programs, had a sense that they were going to fly out the door very, very quickly. Obviously, they're hoping to get more funding to try to support this. It's much more difficult on a local level than it is on a federal level. So I'm not particularly optimistic about this. If this comes available again, it's for businesses that have 100 or fewer full-time equivalent employees that have suffered the same type of significant revenue loss, that's 50% or more. And there is a priority for restaurants and storefront retail here. You know, the reasons may not be obvious, but the idea is those businesses are keeping a number of people employed. They're providing what are crucial services for many people. So that was a preference. It's sort of sad when you try to find updates from the county, but at this point in time, the county is encouraging businesses who are interested in these loans to look elsewhere. So the PPP loan forgiveness has some tax implications. And Aaron, can you pick up that for us?
Sure. Yeah. With the CARES Act, in addition to the loan forgiveness and the potential for, tax-free loan forgiveness income, there were other tax pieces that came to it. The first piece is that what they're allowing you to do with the CARES Act is that as an employer, you can delay paying 2020 payroll taxes, 50% to the end of 2021 and the other half to the end of 2022. But proceed with caution if you're going to go with this. While this is a nice way to preserve cash and delay making some payments, but just understand that at least half this money, this is your employees' money. This is their tax withholdings. And if this money goes out the door, it's on you to replenish it. So please be careful if you, proceed with this one. The IRS is very aggressive with collecting payroll taxes compared to other income tax.
Aaron, I don't want to interrupt, but I'm going to, because employers should keep in mind that the directors, there's usually not a lot of personal liability for directors of corporations, but this is one of those areas that you could be held personally responsible.
That is correct.
So
yes.
I think that's really good advice to heed from Aaron, is that keep an eye on the dollars that you have available to make these 50% payments in 2021 and 22. Sorry, Aaron.
No, it's a great point. Well taken. You know, with payroll taxes, and we've seen this from our firsthand experience, they will come after the owners potentially for personal liability if they don't get their payroll taxes. A few other neat things that came with this CARES Act from the tax side is the first thing is the net operating loss carryback is back. And what this allows us to do is that if, let's say, you know, you have a loss from a business, and what you can do is you can take that loss and you can take it backwards to a year where you had income, and you can offset the income in a prior year and get some taxes refunded. So if you're a C corporation, the corporation would do it. If you're an S corp or an LLC where the income passes through to the owner would personally file that NOL carryback. And there's some really nice dollars that could come from this. And this is, you know, if you had a loss in 18, 19, or 20, you're eligible to the carryback, you know, backwards up to 5 years from the year the NOL was generated. Another thing, and this is, you know, endear to me personally, is that, you know, a lot of, you know, we have a lot of folks where they did a build out. And when you do a build out, you know, you buy furniture, fixtures, equipment, computers, but you have the interior build out where you take the inside of your building space and you gut it out, you put in walls, you know, you redo it. And this is considered qualified improvement property. And when the Tax Jobs and, Cuts Act came a couple of years ago, there was a hiccup in the way that it was written, and it was intended to allow you as a business owner to do 100% bonus depreciation, but they went back and they technically corrected that. So now, if you do a build out and there's qualified improvement property or interior build out, you can write off that build out 100%. And so you would do this in year 2018 or 2019, and you're able to do this through the end of 2022. So even if 18's taxes have been filed or 19's been filed for a lot of people, there's still time to go back and amend that and claim that tax deduction. And that could be a really sizable tax write-off.
This is great. How often do accountants get to talk about losses being a good thing?
Once in a while. This is great, I tell you.
So, all right. Thanks, Aaron.
Thank you.
So moving past some of the loan vehicles, for those of you that participate in Medicare, there is an accelerated advance payment program that Medicare runs. If you haven't heard about this, this is certainly something that's worth looking into. This is an expanded and accelerated program of what is already in place. And this is going to continue through the current public health emergency. At least that was the last guidance. And if you apply for this, CMS essentially will advance 3 months of Medicare payments to your practice. It's essentially a free loan, so don't get carried away that these are dollars that are coming in you don't have to account for and you don't have to worry about paying back. While you don't technically have to account for them and pay them back in the traditional sense, there is going to be a reconciliation, and these payments will essentially be offset from new Medicare claims that you submit. That's not going to begin, however, until 210 days after the date of the accelerated advance payment. So it is giving businesses a little bit of infusion of cash up front and enough time that you can try to plan around how you're going to use it. To qualify for the advance and accelerated payment program, you have to have billed Medicare for claims in the prior 180 days. You can't be in bankruptcy proceedings. It's not to be under the medical review or program. You can't be under a medical review or program investigation, and you can't have any outstanding or delinquent Medicare overpayments. The application for the program itself is handled through your MAC, your Medicare Administrative Coordinator. So if this is something that may help your practice, I have several clients that have applied for this. You should contact your MAC and work with them to get that application submitted. The response time is supposed to be within 7 days, so it could be money fairly quickly. There's also the CARES Act Provider Relief Fund. This is something that caught a lot of people off guard. We got a number of calls in mid-April about, gee, we just noticed $9,000 in our bank account. We're not quite sure where it came from. And it was particularly confusing for people who had applied for one of the advanced or accelerated payments. But this is different. This is something that HHS did directly. It took approximately 6.2% of total payments made in 2019. It was $50 billion total. The initial $30 billion was already distributed as of April 24th. the initial amount that you received would have been based on your 2019 Medicare fee-for-service reimbursements. This is dollars that really just showed up in your bank account. Overall, as they move into the second tranche of dollars, that's that additional that additional $20 billion, the overall calculation is supposed to be based on your 2018 net patient revenue. If you didn't have adequate cost reports, you can still submit information to HHS. If you go to HHS's website, there is a very good Q&A available, as well as links and to how to submit this information. The acceptance of the deposits is something that you have to be mindful of. If you intend to use these dollars, it does come with a number of terms and conditions. And what they're asking is for people to actually sign off on this, and they're requesting a certification. If you don't do that within 30 days and you are holding on to the money, you're going to be deemed to have agreed to the terms. Overall, the terms and conditions require a certification from the provider that the provider provides or provided services, essentially diagnoses, testing, or care for individual with possible or actual cases of COVID-19. Two good notes there. The services do not necessarily need to be specific to COVID-19, and HHS has said that it views every patient as a possible case of COVID-19. In addition, the certification has to state that the funds will only be used to prevent, prepare for, and respond to coronavirus, and shall reimburse only for healthcare-related expenses or lost revenues attributable to coronavirus. So you can see there needs to be, and we're seeing more and more guidance about what services are going to be covered by this. The providers also need to provide a certification that they won't use funds to reimburse expenses or losses that are reimbursed from some other source. Again, this goes back to that double dip concept. And then there also needs to be some agreement not to seek out-of-pocket payments from actual or presumptive COVID-19 patients that's greater than the patient would have been required to pay in-network. Essentially what they're trying to say is you should be, certainly for Medicare participants, the out-of-pocket cost needs to be what is provided for as if you were in network with Medicare. They're encouraging you to do that with all patients, not just Medicare patients. Finally, there are restrictions on what you can do with the funds. Most of these are probably not what most businesses are worried about right now, but these are very political things for the most part. These are not using the funds for lobbying, not using the funds with respect to election activities, not using the funds with respect to abortion activities. You need to keep meticulous accounting with these dollars. There is going to be, as part of this loan, there are reporting requirements, and that's going to happen quarterly. So you want to make sure that you are tracking these dollars that come in. If you satisfy all of these terms and conditions, however, then the payments don't need to be repaid. This is not like the advance program where they're going to be clawing back the dollars. And I think that this sort of relates to what Aaron was saying with respect to PPP funds. We've encouraged clients who receive these dollars, if there's not an urgent need for them, put them in a separate bank account. Leave them there for if you need them. In case there was to be a clawback or repayment obligation, or you couldn't qualify the terms and conditions, it's good to have those dollars available. It doesn't mean that you shouldn't use the dollars if you need them. It just means, just like the dollars you're getting from your PPP loan, if you get it, you want to earmark these dollars as separate and track the use of them. Because one of the things, and we mentioned this with respect to the looking back at who's receiving these PPP dollars, there was significant dollars in the money that was allocated for this program to also beef up investigations and to prevent fraud and abuse. Okay, we were asked to touch on the state grant programs, and I think you can probably sense from all of the red on this slide that it's not a whole lot of good news. So there is one of the terrific websites that Maryland has is this reliefwizard.net. I encourage you to check it. I don't think that you're going to see a whole lot of changes on this in the near future, but ultimately it provides a list of the different types of loan and grant vehicles that are available. Unfortunately, as you can see from the list, which I actually just captured off of the state's website this morning to make sure it was current, most of these programs aren't available. The two in the middle that are available really only apply. The first one is an agricultural type grant. So if you're producing food and fiber as part of your business, well, there may be good news, but for the majority of people that are on this call, that probably doesn't apply. And the other one is the Maryland State Arts Council. So again, unfortunately, while there are some dollars, if you happen to be a physician or a healthcare provider and an artist, maybe there's a blending. Maybe if you're an art therapist, there's some hope, but unfortunately, otherwise, those dollars are largely earmarked and gone. It's interesting, and I don't know if we have time at the end. They did note on the state grant program, the Department of Labor's work sharing program, from a 50,000-foot view that is essentially the ability to have workers cooperate together to participate in Medicare. The simplest example, and I'm really trivializing this, so if we have time at the end and there are questions, we can get into it. If not, Scott and I have worked with some clients on this as well. But from a very, very high generic level, the concept is if you have two employees that are essentially serving in the same job capacity, and you don't really need two full-time employees right now, and they could both work 50% of the time, you may be able to set up a structure where they can share that one job and they can seek unemployment benefit with respect to the other 50%. I'm sure I'm creating more confusion with that, but since it was noted on the state grant program website, I figured I would throw it in there. I want to run through quickly because we've received a lot of questions about telehealth. It's something that we touched on only generically in our original presentation last month, and we did get some questions about it. There's been some additional guidance, so just a little bit of information. Allowing for telehealth was touched on during the CARES Act, as part of the CARES Act. And the idea is really that the government wants providers to continue to provide service. There is an appreciation that what you guys do is absolutely critical to keeping the country moving in the long run. But obviously, with people not wanting to be face-to-face, there's a general feeling that telehealth serves even more of a purpose than it did before. And you'll see that in terms of the exceptions that have been provided. So there are certain Medicare and Medicare waivers in terms of what the requirements for telehealth generally are. Before COVID-19, so before we were dealing with this crazy world in which we're living, the general requirements that a patient, I apologize for the typo, the patient does not have to sing to you. Your patient does not have to be a muse, but the patient did have to appear at an eligible originating site or facility. Essentially, that was, a hospital or a facility that was set up for and approved for telehealth. The patient generally had to be in a rural health professional shortage area. There were some exceptions for this. The services had to be on the list of Medicare telehealth services. The services had to be rendered by an approved type of provider that generally deals with scope of work. And the services had to be furnished through essentially live audio video. You had to be able to see and hear the patient at the same time. Some of that's changed. So during this public health emergency, and that's very important, it's only during this public health emergency, once the world starts to normalize again, the old rules that we just looked at, those are going to come back, right? But while we're dealing with this public health emergency, the key piece is that it removes the eligible originating site requirement. That means that you can have a telehealth visit with your patient even if your patient is at home. It deletes the rural health professional shortage area requirement, right? So even if you're in the great metropolis of Montgomery County, you can engage in telehealth That is a big change compared to what it used to be. In addition, they've added 80 additional services to the list of Medicare telehealth services. So just during this public health emergency, what normally either weren't permitted for certain reasons or were specifically excluded for certain reasons may have been added on. If you consider the number of codes that most of you use in a given day, 80 is a lot. So the idea was to try to make this available for more people. It also permits consultations by telephone for certain services where audio video isn't going to work. On the federal side, there has been a recommendation that states relax some of their licensure requirements. We will touch on that a little bit. And you guys have a great resource because Susan at the Medical Society is very up to date with these things and has some good resources. So she may be able to help if there are specific questions as well. The other piece is that generally speaking, to engage in telehealth, there had to be a pre-existing provider-patient relationship. That's been relaxed a little bit during the public health emergency. State-wise, Maryland has followed the recommendations. I think most people who have paid attention to Governor Hogan and have been watching the news realize that Maryland has tried to be very proactive. So Maryland allows telephone-only services for most consultations now. There's still a preference for audio-video if you can do it, but if not, Maryland will allow telephone-only service for most consultations, not physical therapy, occupational therapy, or speech-language services. There's also a general blanket rule that if you are going to do this, do your best to make sure that you're doing this through some sort of secure app. Zoom is generally seen as helpful. Zoom, I think, has its own health component that it's working with providers right now. What they really discourage you from doing is using public-facing apps like Facebook Live or open chat rooms, things where there may be some disclosure of confidential information. In order to do this, you have to explain the telehealth service and privacy and security issues to your patients. You do not need to be an expert. You need to explain to them that there may be some risks. Also, before you engage in the telehealth meeting, you have to get consent from the client, from the patient, to engage in the telehealth encounter, and you have to note that in your chart records for the visit. Maryland still requires, and I think this is a benefit for most Maryland providers, Maryland still requires that if you're going to be treating people in Maryland, you have to have a Maryland license. And the patient has to be, and the patient and provider both have to be in Maryland. You've certainly seen on the news that that has been relaxed in a number of states. New Jersey, for example, is actually allowing foreign license. This isn't foreign as in Pennsylvania or New York. This is foreign as in other countries. But there's such a shortage and need for help in New Jersey that they're actually allowing foreign providers who qualify to provide service as well. Maryland also has the same scope of practice requirements in place. Okay, so that was a complete whirlwind. I'm sure you're all experts on this now, but a lot of our clients still have a lot of good questions. So Scott, if you could launch this off, that'd be great. I'm going to take a breath.
Sure. Okay, great. So the first question that we've been getting is, can we still get a PPP loan if we have reduced pay, furloughed, or terminated employees to make ends meet? The short answer is yes, you can still get the loan. However, as Aaron explained in detail before, there may be ramifications when it comes to the forgiveness portion that you may end up not being permitted to take 100% of the forgiveness. So there is a consequence, but yes, you can still get a PPP loan.
All right, the second is, if we've reduced compensation to make ends meet, can we use our PPP loan to catch up our employees to where they should have been? And the general answer to this is we're not certain about that. Aaron, have you seen any new guidance on that? You know, when we looked at this last, the idea was that that's not really what this was intended for, that these loan proceeds were really intended to keep individuals employed during the coverage period. Have you seen anything different?
I have not seen anything different. This is another to be determined once we get the loan guidance, hopefully any day now. But really the intent behind this PPP loan is to retain your current workforce or if you let people go or you furlough them to bring them back. So it's more to maintain what you were doing status quo, not to catch up.
Okay. All right, Scott.
Another question that we've been receiving is, do we get, quote, credit for keeping our employment roles and wages consistent prior to the period when we get the loan? So unfortunately, you don't get extra credit or any kind of credit for that matter, because you might have been keeping employees in place when you otherwise might not have had to. So unfortunately, if you did that, that was great, but there's no mechanism within the system where you're going to get any extra bonus for things that you did prior to the receiving the loan.
All right, Aaron, there was a question: is how do the PPP loans work if we have a number of employees making over $100,000?
Right, and
I guess I can handle that one. I was out of queue here, but generally speaking, the PPP loan's only going to apply with respect to an amount up to the prorated share of $100,000 during the coverage period. So if you have a number of employees that are making over the $100,000 mark and you keep them at that compensation rate, only the amount during the coverage period up to the equivalent of $100,000 during that period is going to be eligible for coverage under the PPP loan piece of it.
So we've also been asked what happens if we have workers who voluntarily resign, and how will that impact our loan forgiveness? This is a very, very good question, and we're still waiting for guidance on this. The only thing that we can point out regarding the PPP loans and requirement to maintain your full-time employment, your full-time employees, is it doesn't necessarily require that the same exact employee be employed. It's looking at numbers, not that Jane was employed and now Jane is still employed. It's just looking at numbers, not specific individuals. But we do need further guidance on whether or not you'll be penalized if employees voluntarily resign or have to leave for other reasons.
Okay. If my PPP loan application hasn't been accepted, can I reapply? The answer is yes. There was some concern initially that it's one loan application per customer. And while it's true, but you can put multiple loan applications in the queue. And what will happen is the first loan application that goes through to the SBA, they're going to accept that. And then any subsequent loan applications are going to be pushed aside and denied. So it's the same loan application, same loan, same rates. So it's not going to change anything, but it doesn't hurt. You know, if you're having trouble with your existing bank, it doesn't hurt to get a second one in the queue because it might work out better.
And I'll note, we've actually received some anecdotal information that if your initial loan was with a large bank that may have been overwhelmed, that there may be a benefit for going and talking to one of your smaller community banks. One, there was that special earmark from phase 3.5. Two, they may be able to move faster. And again, as Aaron noted, if they get the loan application in first, it's not a problem that if Bank of America or BB&T comes behind, the second loan application will simply be disregarded.
In fact, I've had contacts at the national banks that are saying we're inundated at this point with our existing clients, go to the community bank. So that tells you something right there, to David's point.
Right.
How does the PPP loan application work if I'm self-employed and I do not have any employees? So the way it's going to work is the bank is going to look at 2019 self-employed earnings, whether that's 1099 income or the net profit of a single member LLC or anything that just goes directly on the individual return. And what they're going to do is they're going to look at the self-employed earnings, just like the $100,000 number we were mentioning. The self-employed earnings is going to be capped at 100,000. So the way it would work is if you're self-employed and you're applying for a loan, they're going to take your earnings capped at 100,000 divided by 12 times 2.5. So the best case scenario, if you're self-employed, you'll get up to maybe 20,833. That's the best you're going to do with this. And then on the flip side, how would the loan forgiveness be calculated if I'm self-employed with no other employees? So 2019 self-employed earnings is going to drive this as well. So what the bank would do is they would look at 2019's earnings, and the 8-week cover period comes into play. They're going to say effectively, okay, we're going to give you this loan, and the intention behind this is that this is to cover the equivalent of your salary or your earnings that you live off of for the next 8 weeks. So what they're going to do is they're going to take that self-employed earnings from last year, $100,000 ceiling, and they're going to divide it by 52 weeks in a year, and multiply it by 8 weeks for the loan period. So the best case scenario with loan forgiveness, assuming you tap out the 100,000, you're looking at maybe just north of $15,000. So to put this in perspective with the last question and this question, you know, if you're self-employed, no employees, you're not going to be dinged. But best case, you get a loan for up to 20,000 or so, and then you get loan forgiveness for up to $15,000. So it's not going to be a perfect dollar for dollar loan in, loan forgiveness out, but it's pretty close. I received my PPP loan. What do I do next? Talk to your accountant, and this is critical. Talk to your accountant. You got to have a game plan with this PPP loan. You know, this is not going to work, you know, not the stereotype with taxes. It's not going to be a type of deal where I'll figure it out on April 15th. You've got to plan ahead with this thing. You got to have a plan for the record keeping, what's going to be the plan for spending the money over the next 8 weeks, timing for paying rent, utilities, mortgage payments, paying your payroll, and bringing back your payroll as well, your employees rather. You know, this is not the type of thing where you can't wait till week 7 or week 8 to spend all the money, and you can't wait till June 29th to bring all the employees back. This is not the type of thing where you wait till the last minute. This is going to be something that's going to be tactical over the next 8 weeks. And in some cases, this could be a 9 to 10 week action item, because if some folks got their loans on April 15th, April 15th to June 15th approximately is 8 weeks, with another 2 weeks to get, you know, maintain your head count by June 30th. So critical, you have a plan for this. Talk to the accountant. All right.
So I think we touched on this briefly earlier, but the question is, what's the interplay between the PPP loans and the EIDL loans? These are different loan vehicles. The PPP loan is going to be much more focused on what can be forgiven with respect to payroll costs and other approved costs, such as, you know, the 25% that may be able to go towards rent or mortgage payments or interest payments. The EIDL loans are more general. The tax piece, though, is don't forget that you can't double dip. So if you're using EIDL loan dollars towards PPP reasons, and you have a PPP loan as well, you know, there may be some forgiveness components, such as the refinancing of the EIDL loan with the PPP, but otherwise there are different loan vehicles that you can look at.
Can I prepay 6 months of rent during the 8-week coverage period and then use that to qualify for PPP loan forgiveness? This is another one that we're going to qualify where we say, let's wait for the guidance, but it's our understanding that the rule with this is going to be, if you want that expense to cover, be part of the loan forgiveness calculation, it's got to be for an expense that's incurred and paid during the 8-week period. So what that means is prepaying 6 months of rent might be game in the calculation. So again, waiting on guidance on this, but there's a good chance they might say no on this. And another question to kind of piggyback off this that we're getting is, let's say I have a payroll that's incurred in week 8, but then I pay it in week 9, does that count? And that's one that's kind of up in the air right now, because, I hear you where you say you incurred it, but it's just a time difference and when the cash goes out the door. But if they're very rigid, and we're going to find out, if they're very rigid about paid and accrued in that 8-week period, that could also be discounted as well.
And I note that with regard to that prepayment of rent, don't forget, if you're looking to get your loan forgiveness here, the amount that you're paying on non-payroll costs can only be 25%.
Yes.
So if you have the ability to prepay 6 months of rent, my guess is that your application probably wasn't correct in terms of how much you were requesting.
Yeah, good point, David. What happens if I don't spend at least 75% of the PPP loan proceeds on payroll costs? I'm going to answer this in 2 ways. I'm going to give you the practical and what we think is the likely answer, and then I'm going to give you the worst case scenario answer. Another one that we need guidance on, what we believe is going to happen is, let's say you're in a situation where you get a $100,000 loan, you do the 25K on rent, utilities, mortgage payments, but you only spend $70,000 on payroll. You're short $5,000 on the payroll. What we believe what would happen and is practical is the bank will make you pay back that $5,000 that you didn't spend. But our fear and our worst case, scenario is the bank could come back and say, hey, when you signed this loan 8 weeks ago, give or take, you said that you obligated that you were going to spend 75% of our loan on payroll and 25% on the other items. We want this whole loan back. And that could be really detrimental if it's true. We hope it's not. We don't think it's likely, but we are erring on the safe side just in case. So really the big takeaway on this is if you get a loan, make sure you spend 75% on payroll and 25% on non-payroll costs. And if you don't, just be careful. Just set aside the money until you have a game plan. And again, we're going to find out very shortly on this one. If the PPP loan money is forgiven, do I still have to pay accrued interest? Another one we're going to qualify and say to be determined. We'll wait on the guidance on this, but it's our understanding that even if you're successful and you get 100% loan forgiveness, they still may make you turn around and pay the accrued interest on that. Again, it's 1%, prorated for maybe 6 months, best case scenario, but, not a lot of money we're talking here, but just something to just be cognizant of.
Okay. Another question is, how does the CARES Act expand unemployment? So one of the things that the CARES Act did was it did expand funding for unemployment. And essentially, if an individual is eligible for unemployment, they would get an additional $600 per week on top of whatever else they would be entitled to under normal circumstances. So it is an additional benefit. We have had some anecdotal evidence that some people actually, some employees may actually do better on unemployment than they would if they were employed. However, that's how the law is written right now, that they get an extra $600 added.
Oh, Scott may have frozen here. All right. Well, Scott, hopefully you will catch up with us. But the timing for freezing was good. So thanks to everyone. I know that we ran a little bit over. I know that there is some Q&A that has come in, and Carissa was kind enough to send us a couple of questions that came in prior to the conversation. So if there are questions that we don't get to, either with going through what was in the chat box or the ones that were pre-submitted, feel free to reach out to us. Fortunately, the three of us are working, and we are answering our phones and we are checking our emails regularly. So Carissa, if I can figure out how to give you back the screen, I know that you have a couple of questions that came in ahead of time that we wanted to go through, and they were largely employment questions. So hopefully Scott will be able to join back in with us. And all right, looks like I figured it out.
Great. So our first question is, can employees apply for part-time unemployment? And if so, would they receive stimulus compensation as well?
So the answer is that they may be able to apply for the part-time unemployment, but that doesn't necessarily change the calculations that are going to be done with respect to the PPP loan forgiveness. One of the things that I didn't understand in the question was whether the they meant whether the employer could receive the stimulus compensation, or the they meant whether the employee could receive the unemployment compensation. But assuming that since this came from an employer, the answer is that if they are receiving compensation outside of you, there's nothing wrong with that. However, if they are only partially employed, keep in mind, as Aaron was going through the summary with us earlier, there's going to be a look back at what your payroll numbers were. And if your payroll has dropped more than 25%, then there may be some, you may be losing some of the loan forgiveness that you have.
So our next question is, may we pay those employees willing to return to work a higher salary than they had before we closed?
Again, the answer is yes, you can certainly do that. And however, the dollars that you're going to get on your PPP loan I see that Scott's back in, and maybe if you can unmute him in case he wants to chime in as well. Thank you. Sorry, I'll get back to that. The answer is yes, but when you're calculating your PPP loan, those dollars are going to be determined on what your payroll was, not what your payroll becomes. So if you decide to pay them more, that may not be a problem if you have dollars in your PPP loan amount and that's going out for payroll. But if your dollars that are being paid out in payroll exceed your PPP loan component, that's something that would just be on the practice. But certainly incentivizing people with pay usually is not a problem.
The next question asks, our practice has been challenged by employees who do not show up for work, but also do not resign, and then subsequently file for unemployment. How should we classify these individuals on the unemployment form?
So,
Sure.
Scott, you want to take that?
Sure. Well, I mean, at that point, they've technically resigned. If you have work for them to do and they don't fit into one of the required leave categories, then they are not eligible for unemployment, and that information should be provided to the unemployment office.
Okay. What is the definition of FTE with regards to the PPP, and how do you account for part-time employees?
Yeah, I'll take that one. And we touched upon this in our presentation, but what a full-time equivalent is defined as anybody that works 30 or more hours. So consistent with the Affordable Care Act, what they're going to say is anybody that works 30 more hours counts as one. And then if anybody works 30 or more or less hours on an average weekly basis, they get prorated. So back to the example that I gave is if David works 15 hours a week, 15 divided by 30 is 0.5. And then you got to do this for all the part-timers. It's really the part-timers that are going to be really complicated. And if you have a really sophisticated payroll company that you work with, they should be able to give you this number so you have a benchmark for February 15th and June 30th.
Okay, great. Can we cut the pay of salaried, not hourly, exempt clinicians due to much reduced office hours?
So the simple answer is yes. However, what we would note is that, and this has been a big issue for a lot of our employer groups, is that most exempt clinicians are under written employment agreement. And the fact that COVID-19 has come around does not change the practice's obligations under the written employment agreement. So if you don't have an agreement, then there is the ability to adjust compensation and hours. You've got to be careful doing that because technically people who are salaried, we shouldn't be tracking hours. So that's something you should definitely call and talk to us about. But if there is a written employment agreement that you have with that employee, make sure you read it. Have us read it, have your lawyer read it. Make sure you look through, because just because there's this change in circumstance right now doesn't change your legal obligations under the written contract.
Okay, so our next question asks, should all employees, irrespective of their pay scale, be subject to the same percentage of pay cut to satisfy fair employment laws? And are there any anti-discrimination is there any anti-discrimination law related liability?
Well, we always suggest that keeping things consistent and giving pay cuts across the board are going to be the most effective way of not violating any anti-discrimination laws. However, you need to be cautious of, number one, that you could lose your forgiveness under the PPP. And also, if you could lose some of your exemptions under the Fair Labor Standards Act. So you kind of need to look at the totality of how much you're reducing by, and make sure that how that's going to play out with your PPP loan, the anti-discrimination laws, and also making sure that you're not violating anything under the Fair Labor Standards Act. But consistency is usually a good way to go.
Does that apply in the same way to shareholder physicians who are employees of the practice?
So, we usually have less concern with respect to discrimination with respect to shareholders. However, most shareholder, if we're talking about a medical practice, most shareholder physicians also have written employment agreements, and that may be a direct physician's employment agreement. It may be lumped into some sort of shareholders and buy-sell agreement, or if the practice is an LLC, there may be other written agreements out there. So the answer is shareholders can certainly do what they would like if there's nothing in place. Usually these decisions are going to end up going through a board of directors, not necessarily the shareholders. That may end up being a technicality because in many practices, the shareholders are the directors, but do be mindful of written agreements that are in place. And of course, there's the practical issue as well, which is who the shareholder is going to sue. I guess they're suing their own corporation. So, I guess if everybody's ganging up on one, maybe there's a fight, but hopefully a written agreement's in place already.
Okay, the next question is, if an employee has used all their PTO due to concern over COVID-19 exposure and continues to not come in for scheduled work, what steps from a documentation standpoint should our practice take in terminating the employee?
Scott, you want to take that?
Sure. So you want to make sure that you've explained that they've really exhausted all of their leave. So you need to make sure that you go through the that your policy handbooks and make sure that if you're taking the position that they've used up all their leave, that they've used up all their PTO, that they don't fit in any other requirements. You could also send them, a final written letter telling them that they are going to be terminated if they don't report to work on a certain date. But again, you need to make sure that you're complying with all of the anti-discrimination laws and the COVID-19 laws. But if you are, and they are unwilling to show up to work, then you are free to terminate them at that point.
Okay, so we're going to move over to questions in the chat box now, and we'll start at the top and move our way down. What if the economy doesn't turn around and you have to reduce salaries or FTEs after June 30th? How does that affect the PPP forgiveness that our practice may be eligible for? And if it does affect it, at what point in time will it not pertain to our reporting requirements associated with the PPP?
Yeah, I'll initiate that answer. And the way it's going to work is that as long as your 8-week period is before June 30th, and if your head count is what it is by June 30th, and you didn't slash payroll by 25% or more by June 30th, you're okay. The way somebody said this best to me not too long ago, basically what this PPP loan does for a lot of these businesses is that it buys you effectively 2 months to kind of see how the market is going to play out. And then after 2 months, if things are still bad, then you can make some business decisions such as laying people off or cutting payroll. But as long as you meet all the milestones with the PPP loan, you're okay with the forgiveness.
Okay, great. The next question asks, do you know if PR costs under the PPP are based on when cash was paid or when services were delivered?
I can take that one, and that's another one that's going to be, we're waiting on guidance for that, but it's our understanding that it's going to be on both when the expense was incurred and when the cash was paid and when the services were delivered. To be determined, but that's our understanding. It's all got to happen within the 8-week period.
I thought I had seen some guidance that said that it's when it is, when the expense is accrued and paid.
Right, correct.
Okay, our next question asks, can the employee retention credit apply to single member LLCs?
So I guess this is, I'm not sure if I'm following it, but I guess this is a single owner LLC that has employees. And I have not seen that come to play. Have Scott, Aaron, either of you seen that?
That's, it's our understanding, and this is another one that's a gray area, but we believe that if you have employees within the single member LLC, it should work because it is, in theory, a payroll credit. So it should be fine. If there's no employees, then it's not going to work.
Okay.
That's our understanding as well. I don't think that there is an intent to discriminate on the type of business here.
Okay, so our next question is about FTE calculations. So if your denominator is 3.2, and you say you rounded it down to 3, to get 100% forgiveness, would our numerator have to be 3.2, or would we get full credit even if it's only 3?
Yeah, that's a tough question, and I think that's another one we're going to need guidance on. But it's our understanding that if your denominator is 3.2, we don't know how the banks are going to round up or round down. I mean, I don't know if they're going to function like accountants where they like to round, but it's our understanding that on the safe side, if your denominator is 3.2, plan for 3.2 in the numerator until further notice.
Okay.
I didn't know that math was going to be involved.
Yeah.
So for the EIDL, is the limit of $1,000 per employee for the advance only per full-time employee, or would it include part-time employees as well?
I'm trying to catch up with your question here.
Yeah, I think with the EIDL, when the application came out, they said you throw in all the employees. There was no technical full-time equivalent calculation. So if you had 2 full-timers and 1 part-timer, that's considered 3. So we believe that a part-timer would count as 1 for
Okay.
this purpose.
Okay, so our next question asks for a part-time worker who has 16 hours a week. If they have to self-quarantine, do they have to be paid at that exact same rate? And if not, what programs should they seek reimbursement for? The employee, not the employer.
Scott, you want to take that one?
So, well, the employee may have to be paid under the Families First Act, but by the employer. So if they're getting the same amount of money that they've always received, then I'm not sure they would be eligible for any benefits. If they typically work 16 hours and they're not working the 16 hours, then they could probably file for unemployment. But like I said, you first need to cross the first threshold to see if they have if there's any employer obligation to pay them under the Families First Act.
Okay. If someone gets reinfected with COVID-19, would we have to give them another set of 80 hours?
I believe it's only one set of 80 hours per employee.
Okay. If an employee is not working due to having the virus and has unused leave, do they have to use their leave first for the first 2 weeks off before being paid the 80 hours that's provided for under emergency paid sick leave if taking off work longer than 2 weeks?
It's typically at the employee's discretion of what they want to use first, but you can't require them to use up their PTO first. You would have to allow them to use the 80 hours if they wanted to. So that generally is the rule of thumb, is to let them use their 80 hours first. Now, if they don't want to use their 80 hours first, you may have some flexibility in how it's structured.
Okay. The next question asks, if, as you mentioned, your PPP loan of 8 weeks evaluation ends or begins 6/15/20, do you have to keep staff until 6/30/20, or could you bring them back on 6/30/20? I think she's asking, does the date start 4/15 to 6/15, or is it actually 4/30 to 6/30 date-wise for the PPP for that 8-week period?
So this is if the loan originates on June 15th. Is that what she's asking?
If the loan originates on April 15th.
Oh, April 15th. Okay. This kind of goes back to a point that we made, is that, and this is something we're struggling with, is that the 8-week period really goes from April to June. And while you can meet all the benchmarks during that 8-week period, but you still have the one lingering one where you got to, restore your FTEs by June 30th to where they were on February 15th. So it's really a 10-week project if you think about it. So you might be okay by June 15th, but you're not out of the woods for that last 2 weeks.
The next question asks if you have any updates on when or if Maryland will open unemployment benefits for those who were independent contractors and were terminated because of the virus.
I don't have any further update. I believe that the best resource for that would be the DLR's website. I'm not sure where they stand on that, but I'm not even certain that they're not accepting applications. They just may not be processing them yet. I would contact the DLLR. I don't have any additional information on that one.
Okay.
I had not heard that they weren't accepting applications from independent contractors or self-employeds. In fact, I actually thought that there was an initiative to expand the program to make sure that there was some coverage. I had not heard that those applications weren't being processed. So I agree. The next step should be a call to Department of Labor and find out if there's a reason that that's not being responded to.
Right, because those people would definitely be eligible. So they should apply.
Okay. If we give bonuses to our current employees as a thank you, can this bonus count toward the PPP loan forgiveness as payroll expenses?
So I think that we touched on this. This I think overlaps with one of the first questions that was sent in advance. But the answer is you can certainly pay bonuses whether or not there are sufficient dollars in your PPP account and whether or not those dollars will contribute to your loan forgiveness may be a different calculation that you have to have. But if there are dollars available and they're being used for payroll purposes and the payroll is not going down, you should be able to use that. Aaron, have you seen any guidance on people having larger payrolls rather than smaller payrolls?
We have not, and our understanding is that it's okay to have a larger payroll than a smaller payroll. Just be understanding that, you got all these milestones that you got to meet with spending all the money, but also restoring your FTEs. So if you want to do bonuses, as a generosity thing, that's fine though, but that won't count towards the hours that you're giving a person specifically if they're a part-timer. So just be cognizant of that. That's my only advice on that.
Okay. So if the IDIL deposited, say, $2,000 into someone's account, they were accepted for that, and then the PPP, they're awarded another $5,000. Can you accept both? And if you don't want the EDIL funds and you would rather just keep the PPP ones, is it possible to return those at this point?
So the simple answer is you can accept both. These are unrelated loan programs, except to the extent that you want to use some of the dollars you received from the PPP loan program to repay a loan component under the EIDL. And what that means is that, keep in mind, if you got $2,000 from the EIDL program, that probably was your initial tranche, and frankly, you probably would have gotten 10,000 rather than 2,000. And that initial $10,000 that's coming out on an emergency basis, you don't have to repay at all. So you can just keep that. That's an emergency grant. If we're talking about something beyond that, and let's say there was a $2,000 loan, you could use PPP dollars to repay or refinance out that smaller EIDL loan. But that's what we were talking about in the earlier slides. You have to be mindful of whether or not you're using those PPP dollars for something that's subject to forgiveness. Otherwise, you may just be substituting one loan for another, and there's nothing wrong with doing that. That should be a fairly simple calculation once you look at what is going to be forgiven and what the loan terms are after the fact. But there's no problem with accepting dollars from both programs.
Just to piggyback what David said is that, if you are successful in getting both PPP money and EIDL money, they've made it very clear that it's got to be for different purposes. So if you get PPP, it's generally for payroll, rent, utilities, mortgage payments. The EIDL has got to be for something else like working capital expenses or accounts payable, as an example. So just be cognizant of that and careful.
That's a great point of clarification. Thanks, Aaron.
Okay, so if you have offered an employee the opportunity to work and they don't want to come back yet because of COVID-19 concerns, this practice was under the impression that the individual could still file for unemployment. So they just want to clarify, can you really still terminate them if they do not want to return yet because of COVID-19 concerns, but would consider it after, you know, the virus is less of a risk from their perspective?
So that falls a little bit into a gray area. You know, Scott, I don't know if it looked like you were going to jump in. I don't know if you wanted to offer, you know, and it really depends on whether or not the individual is, you know, being asked or is, you know, trying to obtain employment. Obviously, under a traditional unemployment scenario, there's an obligation to try to find work. I don't know if I just dropped out. I'm going to assume that I'm still in. So Scott, I don't know if you see that differently in terms of an employee coming back that would have the opportunity to work, but now doesn't want to work and rather wants to sit back and continue to collect unemployment. Oh, I think Scott got muted.
Sorry. No, I'm here. So you have to understand that whether or not you can terminate someone under the employment laws doesn't necessarily mean that their eligibility for unemployment is sort of a different question. But you're free, if someone doesn't want to come back to work and you have work for them and they're not asking for an accommodation because they have a disability or underlying condition that may be worsened due to COVID-19, that may be a different scenario. You're free to terminate their employment. How unemployment will view that is sort of up to unemployment, and that's unemployment's decision whether or not someone will be eligible for unemployment given those facts. But how your business handles it is a business decision, and then from that point, unemployment will I guess evaluate whether or not that's an acceptable reason for not showing up to work and whether or not they want to pay the unemployment benefits.
Okay, the next question is for our part-time employees, when determining FTEs, are we able to increase the hours of one employee and lower hours of another employee, but still remain in the aggregate hours of part-time employees, or is the reduction penalty incurred per employee?
So the number of hours that you're going to be, the reality is that for the loan purposes, the number of hours isn't really what's looked at. It's the overall payroll. The scenario, does raise a question about, discriminatory practices, and I'm not sure that that's the scope of the question. But the reality is when you're looking at the loan and how you're calculating your payroll, you're not going to be looking on an hourly basis. You're going to be looking in terms of what's being paid out to employees. But I'd be hesitant, unless there was a bona fide reason for doing it, I'd be hesitant to penalize one employee with fewer hours and give those hours to another employee only because the penalized employee may have a discrimination issue. Scott, Aaron, do you have a different view on that?
I mean, it's a great point you bring up, David. And, while there could be a play where somebody's working, between 30 and 40 hours a week, and you could move hours from one to the other to make this thing work, since 30 is the cap for an FTE. But just to understand is that you don't want to burn any bridges later, because when this is over, you don't want to, have a problem with that, that current employee, especially if they're a good one. So it's just like anything else we've been advising clients with, managing cash flow and things of that nature. Just be careful. There's plays for now, but be cognizant of later.
Well, you don't want to have to hire Scott to protect you when the disgruntled employee complains.
That's right, yeah.
Okay, so these are our last two questions. If you had someone on your PRN list and helped them out when they needed it, can that person subsequently file for unemployment even though you have not formally let them go?
Is that, we don't know from the question if that individual's an employee or an independent contractor. I don't know if that's just, if PRN means that they're coming in only when they need to. So it's a good question, but if it's an independent contractor, it's probably irrelevant.
Okay, so Dr. Saba, feel free to unmute yourself if you have a follow-up to that. And then we also have a question asking, if someone files for unemployment during this time, does your practice unemployment rate increase for the following year?
Scott, do you want to take that or you want me to do it?
It's my understanding that the unemployment rates are not going to be affected by the COVID-19. I mean, whether or not there's going to be, specifically, there may be an overall increase, but it's my understanding that at least some of the costs are not going to have a direct effect.
So I don't know if people can still hear, but that's my understanding as well, is that in the event an employee is let go during this point in time, that those terminations are not going to impact employers' rates.
Okay, great. So I know we're 15 minutes over, so I'm going to go ahead and close out the session.
Oh, I did unmute myself.
Oh, okay, go ahead.
If that's okay?
Yeah, go ahead.
Okay, so yes, the individual's PRN would come in the afternoon when the office was open to see patients. And sometimes when they couldn't, we just made do. So the person's still on the PRN list. So the question is, I continue paying the individuals if they are there, or they go ahead and file for unemployment. Once we're back in the office full time again, seeing more patients, they'd be coming in to work those shifts.
Hi, Christine. How you doing?
Hi, David. Thank you so much.
Why don't you give me a call? But I think the simple answer, if this is someone who just comes in on an as-needed basis and is really hourly, or presumably paid on an hourly basis or maybe a per diem basis, but there's no contractual arrangement, the general thinking, and Scott, you can jump in if you think I'm missing it, but the general thinking is that if they're not generally incurring hours and it's just as you use them and you don't have use for them, I don't think that they would be included as an employee for purposes of your obligation to pay people. Scott, do you see that any differently? This is essentially a person who's treated as an employee for, it sounds like, probably tax purposes and maybe insurance purposes, but otherwise only works when needed.
Yeah, I think they would have to file for unemployment, and whether or not they've worked enough hours to be entitled to it, is a calculation that unemployment will have to do. Just thinking, would it have any effect on the PPP? That person would be counted as some part-time equivalent, I assume. So
right, it's like 0.35.
So Aaron, that would have an effect on that equation, that side of the equation as well.
Aaron, do you know if the practice could try to claim PPP dollars for this individual, and if they got them, pay them out to the individual, by averaging or something like that?
Yeah, I think they could work. I could see that happening. I think that's probably another one that we're going to need guidance on. But I think overall, I could see that happening.
Okay, Christine, does that answer your question?
So yes. No, thank you.
Yeah, you can always find an answer if Scott and Aaron are with me.
Wonderful nuances, right? That's why you guys have jobs.
Yeah. I didn't just bring them along because they're good looking.
Yeah.
All right. Thank you to everybody who joined us today. We will close this webinar out now. If you do have follow-up questions that weren't covered, feel free to send them to us and we will make sure to get you an answer. We'll send out a post-event email, and that's a great opportunity if you do have additional questions. We're happy to connect you with our speakers. We will make this webinar available online via our YouTube channel, so if you'd like to look back at any part of the presentation, it'll be available to you in that format. And we do encourage you to subscribe to our YouTube channel for other educational content if you found this valuable today. A few things that we'd like to let you know about before we do close out this session. MedChi, the Maryland State Medical Society, continues to coordinate all clinician calls for the state of Maryland with the Maryland Department of Health on COVID-19 every Monday, Wednesday, and Friday. So if you're interested in participating in those calls, you can always visit montgomerymedicine.org. We've got the link to register for those front and center on our webpage every single day. And then our next webinar in this, this rapid implementation webinar series will be held this Thursday, April 30th, and will address short and long-term financial and tax strategies for medical practices during and after COVID-19. So we hope that you will make some time to join us on Thursday as well. And then finally, and we'll include these in our post-event email, we do have some well-being resources. I know it can be really challenging, not just from a legal and tax perspective, managing employees right now, but also from the perspective of supporting them during a stressful and difficult time. So we'll include some information on well-being strategies that our practices have communicated to us have been really helpful for them, and some information about the Physicians Resource Network, which provides no-cost counseling to physicians in the county and is available via telehealth right now. So I'd just like to say thank you again to our speakers who provide such wonderful information to our practices. We could not host these sessions without them. So thank you all so much, and thank you to everybody who participated today.
Thanks, everyone.
Thank you.
Thank you. Thank you for having us.